Well, less than 24 hours until the next Fed decision, but even with expectations of more rate cuts on the horizon, a top housing economist says mortgage rates could stay above the 6% level through 2028. Mike Fratantoni is behind the call. He's chief economist at the Mortgage Bankers Association. He joins us now. Great to have you, Mike. This is very disappointing for a lot of people who are waiting for rates to come down, who believe that rates are going to come down because the Fed is going to continue cutting. So is this a bet that the 10-year yield, that the Fed is not going to cut as much, that the 10-year yield would be higher, or is this completely a different sort of untethered call to that?
Yeah, well, thanks for having me. Appreciate the opportunity to talk with y'all. Yeah, we expect the Fed's going to cut tomorrow. We expect they're going to cut, 3 or 4 times over the next 6 months or so, and responding appropriately to a weakening job market and a slowing economy. They're going to be prevented from cutting more aggressively from the fact that inflation, we think, is going to keep rising from here due to tariff-induced effects. But exactly to your point, 30-year mortgage rates really much more closely tied to the longer end of the yield curve, 10-year treasuries and beyond. And we think those are going to continue to be pushed up by rising term premiums, investor fears that inflation is going to pick up again, and concerns about just the level of the debt and deficit and just the ongoing treasury issuance that's going to be needed to support that. So, as you said, our forecast is mortgage rates, at least on average, not going to move too much from this sort of 6 to 6.5% range we've been seeing recently. Just in the last couple of weeks, we're down to about 6.25%, which is the lowest we've seen this year.
So what is your outlook for the housing market then, Mike, if you think that rates are going to stay elevated or within this range, which is, in many people's view, elevated, and the employment picture worsens?
Yeah. So 2023 was the low point for the housing and the mortgage market. Things just slowed to an absolute crawl after the Fed raised rates by 5+ percentage points. We saw mortgage rates more than double and touch 8% at one point. It's gotten better in 24, a little bit better in 25, and we think we'll see home sales increase in 26 by about 5%. What's really changed, though, is where the last couple of years for a potential buyer, the real frustration was the lack of inventory on the market. That's changed in 25. Builders have been busy putting up new units, and even existing owners have been more active in terms of listing existing properties. And the benefit for the buyer is a whole lot more inventory to look at. The challenge for the seller is it's taking longer to sell, and we've really seen home prices flatten across the country.
All right, Mike, over the last 50 years, there's nothing extraordinary about 6.5% mortgage rates. I think it's the rate of change that scared people. So my question is, how long does it take for the sticker shock to wear off where people are comfortable with 6.5%?
Yeah. Well, I think for the first-time buyer, they've already acclimated to this. They have budgeted to a 6 to 6.5% rate, and they understand where home values are in the markets where they're looking. I think the challenge, to your point, is to that potential move-up buyer who, maybe they locked in a 3% rate, and understandably, they are reluctant to give that up in a market where we're now 6 to 6.5. So we see this as a market both because of demographic reasons. The millennial cohort is so big, it's leaning towards first-time buyers, and the fact that you have these reluctant move-up buyers. But as I said, in 2025, we've seen existing inventory increase, call it 30% above where we were last year. And I think that does say that some people are getting, again, acclimated to this idea that this is the new normal level of mortgage rates.
Mm-hmm. You mentioned the builders, Mike, and the builders have been buying down mortgages, to a 5.5% level, 5% level, thereabouts. And so do you anticipate that this continues, or will that becoming acclimated to this new rate, will that allow the home builders to stop buying down to that extent?
Yeah, well, I mentioned that inventories are up, and that's particularly so on the new construction side. We've got about 9 months of supply at the current sales pace. And so builders are very interested in moving those properties, particularly the move-in ready properties. And I think what they've found is that offering a buy down, particularly a permanent buy down that rate, is a very, very effective way at getting customers. So I think that's going to continue until we get that new construction inventory back down to a more typical level.